And so the idea is that most Australians are self-funded retirees in the future. Another form of investors are hedge funds. These funds are market neutral, so there's no beta risk and there's only alpha risk. The next type of funds are foreign funds, which are funds which have a mandate to buy and sell international shares instead of companies listed on their local stock market. So, for example, in Australia, it would be anywhere outside Australia, like the New York Stock Exchange or the Hong Kong Stock Exchange. Sovereign wealth funds are large government-owned funds which invest both locally and internationally. And lastly, private equity funds are funds which buy and sell whole businesses which are listed through the stock market, and they usually buy them and fix them up, change their debt structures, and then sell them for a profit. So, what are some advantages of listing your company on the stock market? There are many reasons why a company chooses to go public and list on the exchange. And the main reason is that they want to raise more capital. So Mark mentioned a lot of this before. The process is called an IPO, or an initial public offering. And this is when the company first goes public and they choose to raise capital. They can do this for a number of reasons, such as to fund a new project or acquisition, or pay off existing debts, or just to keep growing their business organically. By listing on the stock exchange, the original founders or investors of the company can be paid and thus increase their own personal wealth. This is particularly good for founders whose companies have grown substantially in value, but they want to diversify their investments and don't want to have all their eggs in one basket. And they can also cash in some of their profits but still maintain control of the company if they choose. The process of listing a company also gives everyone, not just the founders, an idea of how much the company is worth, or at least the price people are willing to pay for this company. Listing on the stock market also means that the company can expand their shareholder register by increasing and diversifying the number of shareholders. This spreads the ownership of risk between more investors, which is important when growing a company. And the media coverage, which sometimes comes along with listing a company on the stock market, means some companies can also increase their market share with the publicity. But what are some disadvantages? So companies may choose not to go public because the management will lose control of the company when the company is listed. And once a company is public, they are accountable to the shareholders, and big decisions will need to be approved by shareholders. Companies are required by the ASX to release a lot of information when they are listed, such as their revenues, profits, borrowings, etc. Companies are wary of releasing too much information because once the information is public, anyone, including their competitors, can see the information. Companies which are listed are more vulnerable to hostile takeovers, as other companies can start buying shares in their company if they want to take over and slowly become large shareholders. You cannot stop anyone from buying your shares, and so this could eventually become a problem. Management will also need to spend time interacting with investors and analysts when they become public, and this could serve as a distraction if they don't have their own investor relations team, as they will need to take time to prepare and talk to shareholders and analysts. There are also lots of fees involved with going public, compliance fees from the exchange where the company is listed, as well as investment banking fees to list and those sort of things. So I'll go through a few key definitions which you'll need for our 2 lectures. The first is market capitalisation, which is the total market value of the company. So it's calculated as the share price multiplied by the number of issued shares. And then we also have the free float, which is the market capitalisation of a company less any shares which are locked up. or unlikely to be traded. So these include shares held by the founders which are very unlikely to be sold. And the equation is seen there. So liquidity is the ability to trade what you want, when you want, and at a fair price. And so there are 4 dimensions of liquidity. Firstly, immediacy is how quickly trades of a given size can be arranged at a given cost. Secondly, width refers to the cost of doing a trade of a given size. The depth is the size of a trade that can be arranged at a given cost. And resilience is how quickly prices revert to former levels after they change in response to large order flows imbalances initiated by uninformed traders. So investors and traders prefer liquid markets and liquid stocks, as it means that they can get in and out of the shares quickly and easily if they need to. And our last definition is the bid-offer spread. And so this is the difference between the highest price a buyer is willing to pay for a share and the lowest price a seller is willing to sell their share. So you can see here the bid offer is $32.43 to $32.46. And so the bid offer spread is 3 cents. So this chart below is showing that currently the person willing to pay the highest price is willing to buy 1,000 shares at $32.43, but someone is willing to sell 1,694 shares at $32.46. So at the moment, no one is trading because no one is willing to move their price. But if you decided you were happy to pay $32.46, you could jump the queue and pay a higher price and buy the shares at market. So to explain the difference, I know some of you have already bought shares, but for those who haven't, there are 2 types of orders you can put on when you want to buy a share. There are limit orders and market limit orders. So for limit orders, you put in a specific price of what you are willing to buy or sell the share. So a limit bid order is the maximum price you are willing to buy the share for, and an ask order is the minimum price you're willing to sell the share for. So in this case, you can see these people have put on limit orders with the prices they're willing to buy and sell. The other option is to put a market limit order, which means that you will buy the stock straight away at the price given. So if we go back to this example, if you were willing to buy the stock at any price, and say you wanted to buy 1,000 shares, you would pay the $32.46 in this example, as it's the lowest price that you could possibly buy that share right at this moment. On the other hand, if you were looking to sell a share, say you're looking to sell 1,000 shares and you put a market limit order, you would be selling at $32.43 because that's the highest price someone is actually willing to pay at the moment. Does that make sense to everyone? Does anyone have any questions? Okay, so I think, did you want to have a break or keep going? So Mark will do the next section on different markets.
Thanks. So this slide shows you the market capitalisations of most of the major stock markets around the world, and you can see that the US market, the New York Stock Exchange, is close to $20 trillion, which is an enormous number, obviously. And this is actually at an all-time record at the moment. I have a chart later on of how high the market's been moving. You can see the American market really dwarfs all these other markets around the world. Even economies like China and India that are very, very large economies are dwarfed by the US share market. And I mean, there's partly historic reason that a lot of companies in China and in Asia are publicly owned, not publicly owned, they're government or privately owned, whereas most corporations are publicly owned in America. You can see that outside, this is the NASDAQ, which is where technology companies are listed in the United States, and then we have Japan, a number of Asian markets. So Japan is the biggest Asian exchange, and Australia is very, very tiny down here. So just by way of summary, here's just a rough outline of how the markets sort of shape up in Asia. I thought you might be interested in the Asian market, since many of you might be returning to Asia in the future. And really, we've got Hong Kong, Japan and Korea are the most mature share markets in Asia, and other markets like Singapore, China A and China B shares, the Shenzhen and the Shanghai exchanges are not so well developed, but obviously are growing very, very rapidly. One thing that you have to be aware of in different markets is that each market has its own listing rules, and they can vary quite considerably. So the quality of the listing rules affects the trust that you have in the corporations that are listed there. And for example, in Australia, there are very strict rules on continuous disclosure of information so that everyone is operating on a level playing field. Whereas that may not be the case in some of these Asian markets, which are not well policed. So really, we want a very strongly well policed market. And that's probably something that needs to happen more in China. I suspect that Chinese investors are not all trading with the same amount of information. It's obviously incredibly unfair if you're buying or selling shares and you have less information than the person on the other side of the transaction. You won't do so well out of it. It's effectively sort of insider trading. Now, you see here that their listed warrant trading happens a fair bit in Hong Kong in particular, and warrants are just a synthetic form of a share, usually with a loan attached. So you might have, say, a $10 company. You could buy a $3 warrant where effectively you've got a $7 implicit borrowing inside the structure. So it gives you more leveraged trading in the shares. Now here's the first chart that we've got here shows the performance of the Hang Seng index in Hong Kong. And this is a fairly familiar pattern we see in a number of exchanges where we've got strong growth through the 90s and up to this 2007. And obviously this big dip here is the global financial crisis. So the global financial crisis wreaked havoc in the Hong Kong exchange. I think you can see it's fallen, it probably more than halved in that period, which was quite a substantial decline, very, very quickly too. And this is sort of an unprecedented sort of disaster in most markets. Even in the 1987 crash, markets actually recovered quite quickly and the fall was not so profound. This is really the biggest decline in global markets since 1929. It's quite unusual. And we can see that markets have not quite fully recovered. There was so much froth in that share price. We still have yet to reach that level, even though the time value of money has actually increased since then. So you can see by the market capitalisation, $3 billion, it's not an enormous market. Australian share market's about 1.6, 1.7 billion. So it's about twice the size. In the lecture notes we explain that the exchange is working on, there's just been a recent new link formed with China. What's it called again? Yeah, it's called Hong Kong Stock Connect. Kimberley's actually been over just before the launch last year to check it out. And what it enables is Hong Kong investors to buy China mainland shares through the Hang Seng Exchange, and also vice versa. But I'm not sure how liquid it's become so far, but it's quite a big development. So in China we have these are the two main exchanges, which I'm sure many of you be familiar with, and the Shanghai Exchange is the older one, and it's really probably the more liquid one. And historically we've had the A shares and the B shares, where foreigners were only allowed to trade in the B shares. But now we've sort of got this bridge, Hong Kong Connect, happening through Hong Kong, so that's going to become less important going forward. This is the development of the Shanghai market. Similar sort of crash, probably even more profound. The market fell about 2/3 from close to 6,000 to below 2,000 back in the GFC. Here we see, despite the enormous powerhouse of China, this is up to date at February, relatively small, very tiny market capitalisation. So this would be a fraction of the US share market, probably not much more than 10% of the US share market capitalisation. But this number is going to grow enormously over the next 5 to 10 years, and probably within 10 years, the China capitalisation will possibly meet or exceed the US level. The Shenzhen Exchange is a slightly smaller market cap. Here we have the Tokyo Exchange. This is actually, it's an interesting chart because it's quite different pattern. Here the market peaked in 1987, and Tokyo has actually never recovered from the 87 crash, despite being more than 25 years ago, close to 30 years ago. And it feels actually that if you read any financial press, they focus on this very strong rally here, where the market's moved up by well over 50% in the last couple of years. But interestingly, still well below these levels. And what this unusual chart reflects is the Japanese economy has been in a fundamental malaise. It basically this was a huge bubble, and there's just been this huge indigestion in the Japanese economy, which has suffered from very, very low growth, almost like a deflationary scenario. In fact, some people think Europe could end up like this, with very low growth, anemic growth, and very low inflation. But the Japanese government's been trying to stimulate the economy, and the yen's depreciated significantly. At the moment, we can buy 93 yen for an Aussie dollar. That's significant depreciation. And the yen's been very, very weak against the US dollar, obviously, which is the main measure. Obviously, when we look at all these indices, we're looking at them in local currency terms. But it's quite interesting to look at these charts in US dollar terms as well, which is a more absolute benchmark. But they're not normally ever published in the US dollar index. One thing to note with all these charts is that these are all nominal values. So over time, with the time value of money, you really should get an asymptotic rising line, and it just sort of highlights how poor those numbers are in Tokyo. Now, this is a Singapore exchange, which is fairly trivial, and I won't really drill on it. Again, we've had a crash here and a fair bit of recovery since. This is the main market I really want to talk about, and the main benchmark index in the US is the S&P 500, which is obviously pretty much the 500 top companies. And here we see it's headed up. These are the largest constituents of the index, with Apple, Exxon, Microsoft, Johnson & Johnson, Berkshire Hathaway, Wells Fargo and General Electric. And General Electric's the topic of our assignment that's just been posted, interestingly enough. If we look at the index constituents, this pie chart's interesting. What you note really is that there's a huge industry diversity in the United States, and not too many sectors completely dominate the index. The largest is information technology, where companies like Google, Apple, Microsoft are very, very highly rated. I believe, looking at this, that the largest market cap at the end of January was $687 million US, which would be an enormous number. So it's $687 billion market cap. That would be obviously Apple. And here we see the chart of the US share market. And this is the most profoundly bullish market, rising prices that we've seen of all the markets that I've showed you. And it's interesting, we have three peaks here. And this period was the dot-com crash. So dot-com, this is when the internet first exploded. So the internet started at this point of inflection. And this was when euphoria rose about the advent of internet companies. And then these companies, many of them failed to get traction. And there was a reality check. Prices fell sharply. And then we had a very strong period of US economic growth here, which ultimately led to the GFC plummet here. And now we've had the recovery with virtually zero interest rates in the United States, creating virtually an asset bubble at the moment and all-time record prices. Obviously, this line is all in nominal terms, not in real dollars. So it would be useful to chart it in real dollars, and I've got a chart to show you in a minute. It's interesting if we go back here to 1987. That's what people consider one of the worst crashes ever. That's a bit of a dot on the radar screen now. A bit obscure. It's possible with any index. Obviously, this is an index of all the top 500 companies. So an index is just the weighted average share price of the constituent 500 companies. So as a company gets into the top 500, it replaces a company that drops out. So we've always got a basket of 500 stocks, and it's just the index takes the weighted average price every night or every day, weighted by the market capitalisation of those stocks. So it's a value weighted index. It's possible to also construct an index of the earnings of these companies, which you very rarely see, but Kimberley's extracted this data. It's actually publicly available on a website. And what it shows is that earnings have been rising quite strongly, which tends to support the valuation of the share market. So in some cases we see that the share market got overpriced, but it's quite feasible that valuations are not unreasonable at this level. So if we wanted to, basically the most basic measure in the share market for assessing the value of a share is the price to earnings ratio. So that's where we take the price of a company and divide it by what it earns and see what is that multiple. So a price earnings ratio in the States has varied somewhere between 10 times and 30 times for most constituent companies. Typically, we're in the high teens, low 20s, historically for price earnings multiples. Obviously, the inverse of the PE ratio is the earnings yield of a company. So if you have a PE of 20, your earnings yield is 5%. That would be after tax, of course. These are earnings after tax earnings. So why would you buy a company for a 5% earnings yield? Is that a good return that you would expect to get? Well, actually, you don't expect just to get the earnings yield. You expect to get the growth on that company. So if a company was to grow its earnings by 5% per annum, and you're already earning 5% now, mathematically, I can prove to you at some point why, but the total internal rate of return on that share would be the sum of the growth rate and the initial yield. It's actually a simple geometric progression. So your total return would be about 10%. Markets tend to deliver 10% typically over time. That's the typical return on equities. And if I just take this chart further, what we've actually done is Kimberley's done a log of these earnings. So it does show that over time earnings grow quite consistently and the variation is much less on a log scale. So this, effectively, by taking the log of the chart, you're eliminating the time value of money issue. So it's effectively putting it on a compound, removing the compound interest aspect. Now here we've plotted the ratio of the S&P 500 chart divided by the S&P earnings chart to get the history of the PE ratios in the United States. This is a fascinating chart which I hardly ever see in the financial press. We've constructed it. We could probably make money out of marketing this chart because it's probably the most useful litmus test of how dear or expensive the market is. And you can see it was a very good signal that the market was cheap back in this period here. Generally, the market's traded between 15 and 20 times earnings. And up here, where the market got significantly overvalued, was a strong signal that it was going to correct. Interestingly, this was a very strong signal that the market was undervalued down here. And this is about where we are at the moment. And most commentators say the US market is too high. But when you look at this chart, that red triangle, which is actually based on the forward earnings estimate, is not unreasonable. Now this is the sort of chart you might want to look at when you're doing your assignment question, because in the assignment you will need to value the GE Corporation and you'll need to determine a price-earnings ratio that could be relevant for the company. We'll just briefly touch on the Australian market, but it's very boring compared to the US market, which is really where all the action is. And we have, although it's boring, it is a very liquid and sophisticated market and very well policed. And about 2,000 listed companies here. Interestingly, our market has yet to reach the 2007 high, but has been very, very strong. In fact, about a week ago it got to 5,996. It's 4 points below 6,000. If we measure the returns on the market, generally we calculate the 20-year return was 9.9%. You can measure returns ex post, or you can forecast returns ex ante. We would expect ex ante returns to be similar. There's some numbers about the capitalisation, which I won't bore you with, but you can see here how much, this is back to our Bath, how much money was raised, including placements and secondary issues. It's a quite substantial amount. Last year was a very good year. So the ASX is it's only the 11th largest market in the world, but it is a very liquid market. And the $A is one of the most traded currencies also. So this is the chart of how the market's performed. And you can see we're yet to reach the previous levels. But we're getting quite close at just under 6,000 recently. Obviously, again, this is nominal numbers, not on real earnings. If we included dividends, these are only price indices, but if we counted dividends, you'll get what's called an accumulation index, and this number would exceed the previous peak if you took into account all the dividends that have been paid. This is a chart over the last 20 years, and just measures the return at about 9.9%. If we count franking credits, we've earned 11.4. Again, this is just a price index, non-accumulation index. But to work out total returns, you need to take into account dividends. So in this chart, the dark blue bars include the impact of dividends. It shows you how many calendar years have been negative. And really, the only major, well, we've had 3 negative years out of 20, which is really quite typical. But this was an unusually bad decline, which is quite abnormal, even in a 20-year period. This chart compares the constituents of our index with the US market. And you'll note that in Australia we have a disproportionate number of financial and bank and insurance companies, forming nearly half the index, which is quite bizarre really, because